and welcome to this Centre for Policy Studies webinar on pro-growth tax reform for the UK. The context of this webinar is the launch of a new report jointly by the Centre for Policy Studies here in the UK and the Tax Foundation think tank in the US. We have got a great panel of speakers for you for this webinar to discuss all the issues in the report and the general topic of pro-growth tax reform. We have Daniel Bunn, who is the Vice President of Global Projects for the Tax Foundation in the US. We have Helen Miller, who is the Deputy Director of the Institute for Fiscal Studies here in the UK. We have Jessie Norman, who is the Financial Secretary to the Treasury. And finally, we have Tom Clougherty, who is the Head of Tax here at the Centre for Policy Studies in Westminster. I think I'll just sort of set out the kind of context for the discussion and the sort of why this is particularly topical at the moment. Obviously, there's a lot of concern at the moment about the impact that the pandemic in particular is having on the economy. So it would be interesting to hear what panelists think about the role of tax reform in the UK's economic recovery after the virus and bouncing back as quickly as we can, but also the role that it can play in tackling some of the long-term issues that way predate coronavirus, particularly the productivity problem that seems like we've been talking about for years and years now, and nobody seems to have had any answers to. But it will also be interesting to sort of hear, probably particularly from the Minister, about the prospects for tax reform, whether there is scope politically for kind of wholesale tax reform agenda to boost growth, or sort of whether sort of more piecemeal approach is going to be likely, whether, for example, the government sees it as a big part of its levelling up agenda. I think also, obviously, the fiscal context will be important, you know, with the economic hit and the emergency measures that have been put in. There has obviously also been a huge fiscal hit. And as the Chancellor starts to look to fix the public finances, there is obviously chatter in the press about the potential for tax rises, whether they're coming down the line. Be interested to hear what the panelists think about whether that will be necessary, and if it is, whether there are particular tax rises or particular tax changes which can raise revenue without damaging the UK's long-term growth prospects. So with that, I think I'll hand over to our first speaker for his introductory remarks, which is Daniel Bunn from the Tax Foundation.
Thank you, James, and huge thanks to CPS generally for partnering with Tax Foundation on this report. It's a pretty exciting thing to be able to release something of this nature during this time. Huge thanks to Tom and to James and to my colleague Elke Ozen for all the work that's been done on this. Like James mentioned, I'm from the Tax Foundation based in Washington, D.C. And I'm going to have a few remarks about the way Tax Foundation sees itself in the context of this report and our work on policies in other countries, and about the International Tax Competitiveness Index, which is the lens through which we're looking at the UK tax system in the context of this report. So the Tax Foundation has been around since 1937. Throughout most of our history, we've only focused on US domestic tax policy, particularly at the federal level, but also at the US state level. In recent years, however, we've been building tools to help us compare tax systems around the world. Tax Foundation is constantly trying to promote principles of sound tax policy, including simplicity, neutrality, transparency, and stability. And the index allows us to zoom in on country tax systems, and as particularly countries in the OECD, the more developed countries, and look at this question of neutrality. We know that tax distorts economic decision-making. It can distort economic growth incentives and investment incentives. And our question that we ask with the index is how much does the tax system minimize economic distortions while also raising revenue for other purposes. We recognize that tax systems differ vastly across developed countries, and we use the index to say, well, one country is designing taxes maybe with multiple layers of taxes on the same stream of income, or maybe another tax system is simple, straightforward, and easy to comply with. But we also look at marginal tax rates, whether competing countries that are close in proximity to each other might have different marginal tax rate structure that may incentivize a shifting of investment or shifting of location if high earners want to move to a lower tax jurisdiction and things like that. So we recognize that countries are setting tax policy in sort of a competitive context. And we know that tax competition exists outside of our index. Even if we didn't publish the index, tax competition would exist, those pressures would exist. And what we're trying to do is take a principled approach to the tax structure that countries have and be able to compare countries on whether they are promoting good principles of tax policy. Now, the index looks broadly at tax systems. We don't cover everything that comes with a tax policy system, but we look at corporate taxes, individual income taxes, consumption, property, and the treatment of profits earned overseas. So it's a broad view of the tax system, and it's not particularly tied to the amount of tax that a tax system raises. So we look at the structure of the system rather than simply the tax to GDP ratio. You can look at our index and see that Sweden ranks in the top 10 at number 7 and has one of the highest tax to GDP ratios in the OECD at nearly 44%. Now you can look at the other end and see that Italy ranks at the bottom with a tax GDP ratio of about 42%. And you recognize that it's not necessarily about how much a tax system raises, but the structure of the tax system and whether those the policies that are in place that are raising the revenue are more or less distortive to decisions and behavior. Now, for the UK ranks at 22nd in the index, just behind the US, which ranks at 21. And you think about the UK system and think about the relatively competitive corporation tax rate at 19%, but you have to think about the other things that the index covers. The index covers 40 or so variables that don't just look at the rates, but look at tax-based decisions. Policymakers can impact whether the tax system is more distortive or less distortive, not just on the rate, but on the tax base. So even though there's a relatively low corporation tax rate in the UK has one of the most penalizing systems when it comes to business investment, particularly investment in industrial buildings. It ranks in the bottom of the OECD for that. And other weaknesses include the VAT-based design, which applies to less than half of the potential tax base. There are stories regularly in the news about the complexities and the edge case decisions of whether something gets treated under a special rate or under the main rate. And these can create compliance costs for businesses, but also add other elements to the decision-making for consumers. And we recognize also that the UK has a relatively high tax rate on dividends. This is the net personal income tax rate on dividends. That's about 38%, well above the OECD average of 24%. The UK also has a relatively high burden on property taxes, measured as a ratio of property tax revenue to the capital stock. So all of these things taken together, along with some strengths of the UK system, including its broad tax treaty network, give us an opportunity to look at the UK system, think about why it ranks where it does, and options to reform the system that would improve the rank. And with that, I'll pass it over to Tom to talk about some of the reforms that we have in mind with this report.
All right, well, thank you very much for that, Daniel. Let me say, first of all, that it has been a real pleasure working with the Tax Foundation on this report. These guys are real leaders in the field, I think, of pro-growth tax policy. And their International Tax Competitiveness Index, which Daniel has just talked about and which really forms the basis of our own analysis here, is an incredibly useful tool for comparing different tax systems around the world, for assessing how supportive of economic growth or not they are, and in the UK case, for pinpointing some of the real key weaknesses that a pro-growth agenda here would want to address. Now, the report that we're launching tonight, actually it came out on Sunday. It runs to more than 100 pages. It's based on an analysis that sort of covers 40 different tax policy variables across 36 OECD countries. And I think we make 10 sort of main recommendations, which, taken together, they would raise the UK from 22nd place on the International Tax Competitiveness Index up to 9th place, so a significant improvement. And now, obviously, I could give you in the next few minutes a whistle-stop tour of every recommendation that we make, but I don't think that would be very entertaining or perhaps very enlightening. And more importantly, it would give you no reason to download our report and engage in some light bedtime reading later this evening. So what I'm going to do instead is just focus on a handful of the key themes that I think come out of this research and that I think would have to lie behind a pro-growth approach to tax reform in the UK. And so the first thing that I want to pick up on is that transaction taxes are really bad taxes and that the UK relies on them more than most other countries. The main thing I'm thinking of here, of course, is stamp duty land tax, which we describe in the report as the worst tax on the UK statute books. And I think that title is well earned. It has economic and welfare costs that are wholly out of line with the revenue raised. On a per pound basis, it's probably several times more damaging than the next most anti-growth tax. And look, I think the government has already made a really good step on stamp duty land tax by raising the threshold to 500,000 temporarily until next March. That takes a huge amount of transactions out of the tax net and will make the property market work that much more efficiently. But I do think they need to go further, far from reverting to the previous set of thresholds and rates next March. I think we need to look seriously at abolishing stamp duty altogether. And one of the big advantages, I suppose, of abolishing a tax which is that damaging in economic terms is that I don't think even in the short term, the revenue loss would be as significant as people would expect. Our analysis suggests probably even fairly quickly, you would make up about half of the lost revenue from stamp duty land tax as a result of other economic effects. And in the long run, I think the growth implications of getting rid of stamp duty land tax and other transaction taxes would be positive enough that the revenue is sort of a secondary concern in this case. I know we're very concerned about revenue in general, and I should stress that what we've tried to come up with here is a way of making the UK tax system much more pro-growth without putting a dent in government revenues. We wanted this to be a revenue neutral package overall because we think that's more realistic. But nevertheless, I think that you can look at something like stamp duty and say, getting rid of it is going to bring such benefits that the revenue shouldn't be the first thing in your mind. So transaction taxes are bad taxes. Let's get rid of them. That will be good for growth. Secondly, Daniel's already touched on this, but it's worth stressing. Our current system of business taxation in the UK is really not very supportive of capital spending. And I think this is one of the reasons why business investment is a long-running weak spot in the UK economy. Now, for me, looking at the International Tax Competitiveness Index, probably the biggest shock is our middling rank on corporation tax. And this is despite the UK having the 4th lowest headline corporation tax rate in the OECD. The problem is that tax is about more than headline rates. And when it comes to the issue of writing off investment costs against tax, we're one of the stingiest countries in the developed world. And that has significant implications for how much businesses are willing to invest. Business rates are actually a problem in this regard too, because we have a business rates tax base, which isn't just based on the value of the site in question, but also applies to any improvements business might make to the property. So that includes buildings, it includes some plant and machinery, some infrastructure. And you get this absurd situation where sometimes a business will spend lots of money investing in its property, trying to become more productive, more competitive, and they'll get a huge business rates increase as a result. This is an entirely irrational way to go about taxing property. And so these two things in our business tax system add up to create a real tax distortion against capital investment. Now, that's bad in general. It's bad for productivity. It's bad for growth. I think it's particularly bad for things like manufacturing and the sort of non-London regions of the UK. So when we talk about the government's levelling up agenda, I really think that a revised approach to business taxation and really focusing on this issue of capital investment could pay dividends. The third thing, I just want to highlight this really quickly, investment income and how we tax it. Look, we hear a lot about aligning tax rates on dividends and capital gains with normal income tax rates, and lots of very sensible people support this, including a lot of people on the centre right. I do think it would be a mistake, however, and I think that for two reasons, and it comes through in our research. First of all, most of this income is already taxed in some way at the business level, so we have to reflect that, I think, in the rate that individuals pay, that this stream of income has already been taxed. But I think we also need to be conscious of our international competitiveness and this comparative analysis, and see that if we aligned dividends, or if we aligned capital gains tax rates with those on ordinary income, we'd end up with the highest top rate of capital gains on shares in the OECD. If we did the same for dividends, it would give us the second highest international rate on dividends. So I think what we need to do instead is focus on neutrality, on taxing investment income no more heavily than we tax labour income. And that, I think, would be a good thing for growth. So the things I've highlighted here are getting rid of stamp duty land tax and stamp taxes on shares, actually, reforming the corporation tax base so businesses can more easily and more quickly deduct their investment costs, reforming the business rates base so it's entirely focused on the underlying site value, and then maintaining a competitive investment income tax system. And that would involve, I think, cutting dividend taxes, as Daniel mentioned, because we currently tax them too heavily, particularly at the high end when you take into account corporation tax. Inevitably, as the co-author of a big report which has just been released, I could go on and on, but I'm actually really eager to hear what Helen and Jesse have to say about the report. I'm not necessarily expecting fulsome praise, but hopefully some interesting points for further discussion. So let me stop there and hand it over.
Great, thank you, Tom. So I thought I'd use my few minutes to give kind of overarching comments on the kind of tax and growth frame, and then I'll just flag where I sort of agree or disagree with a few of the main recommendations, possibly to have some debate. So on the framing on the tax and growth, I guess completely unsurprisingly, I agree that growth is super important for all sorts of reasons, and it absolutely completely makes sense to look at the tax structure. We have plenty of room for improvement. So I think I'm on the big picture, I'm on the same page. But I think on that growth frame, there's two things I want to pull out. The first is kind of a pedantic point, but I think it matters. So a lot of what we're talking about when we're talking about growth and tax is really how tax would affect the level of GDP, but not necessarily the growth rate. Now, of course, the level of GDP, the aggregate income in the country, is still super important, but I'm highlighting that because I think it's worth having clear expectations about what we're actually going to achieve. Actually, if you're thinking about really growth rate changes, only a small subset of tax reforms are going to get you really the kind of increase in growth rate, which is a matter if you're thinking about things like outgrowing the debt burden, those might be really important. But for the most part, we're thinking about the level of GDP and level of output. So sort of, I think in the back of our minds, although we use growth as a shorthand, I think that's what we're really talking about for the most part. The second, I think, is just to highlight that there is a trade-off between growth and progressivity. So some of the structural reforms that we talk about that are in this report are ones that I think make sense regardless of your political preferences or your preferences for redistribution. And those are kind of interesting because they're the ones where you might be able to build some kind of cross-party or cross-group support. Especially think about these are long-run reforms. We might need reforms that are backed by multiple parties so that they don't just get changed after every election. But with other types of reform propositions, there is this direct tension because in general, and not always, but in general, reducing the amount of redistribution that's done in a tax system would increase aggregate income. So one of the reasons why consumption taxes may be more growth friendly than income taxes, for example, is that they're generally less progressive. I think what that highlights is that we don't only care about growth. Growth is super important, but we care about other things too. And some of these reforms do come at the cost of greater inequality. So something to bear in mind, people will differ in their views about that. So that's kind of the big picture point about growth and tax. Let me highlight some of the I guess my views on some of the specific options that Tom's just mentioned, again, partly as a point of discussion. So on property taxes, I think we're on the same page. Stamp duty is a horrible tax. I think ideally we'd reform that alongside reforms to council tax. On business rates, similarly, I agree. I think what we really need to do there is kind of, business rates is a kind of a combination of the best tax and the worst tax. We should keep the best bit on the land values and get rid of the bit that Tom was discussing about a tax on the improvements of business properties. I think there's some obvious reforms there. Similarly, I agree on the VAT. We spend about £50 billion on zero and reduced rates. We could get rid of those and easily compensate lower income households and have money left over. I think that'd be a good structural reform to do. On corporation tax, I think my position is a bit more nuanced than the one that Tom's highlighted, at least from what I understand. I think there are merits in making the capital allowances more generous, but if we did go all the way to example for a first year, 100% first year allowances for all investment, doing that on its own would also be increasing the subsidy to debt financed investment and increasing the disincentive to do equity finance investment. So that's actually an area where I'd rather see things go further and have more reforms in this area. And then let me my last comment be on the one where I think I disagree most, with a bigger difference between us, and that's on dividends. So you've highlighted that dividends are taxed at the corporate level first, and I absolutely agree. We should think about the total level of tax on income, so absolutely we should agree with that. But similarly, when thinking about employment income, we should consider the full level of tax on that, which also includes national insurance contributions. So to give everyone a sense of scale, dividends at the basic rate, once you include corporation tax, are taxed at 25%, whereas employment income is taxed at over 40%, just over 40%. So it's not the case that dividends are taxed higher than employment income. I mean, there's a smaller gap at the higher rates, but at the basic rate, it's actually quite a big gap. So if you're just thinking about, neutrality is hard to get neutrality in all forms, but at least if you're thinking about neutrality across legal forms, across do you be a business owner or an employee, you can't get neutrality if you have these really big tax wedges. So I think if anything, there is a good argument to be putting up dividend taxes to increase neutrality across legal forms. I think that's one of the issues that I think wasn't central in this report, is the differences in tax across different legal forms, but I think is actually absolutely central to the UK debate at the moment. We give much lower rates of tax to business income, which I think are inefficient and unfair in many ways, one of our central challenges. And actually, it's a case where I think we're currently using rates to try and fix these, incentivise investment problems. And actually, I'd go back to what I think Daniel said, was I think actually a lot what we should be doing there is thinking about the tax base, thinking about how we're giving, upfront deductions for investments in your own company, for example. I think actually some reforms to the tax base alongside higher rates on business income would be a better way to deal with investment incentives than giving these lower rates to business income, which we know end up also creating problems at the top. So let me finish on by saying, at the top, I think whatever you think the right top rate of income tax is, whether you want to scrap the additional rate or not scrap the additional rate, I do think it's a case where, well, first, there's a trade-off between growth and progressivity, like I said, so people can have different political views on that. I'm not taking a stance on that. But I think it's hard to argue that combined rates should vary so much across different types of people. So some people get capital gains treatment and pay only 10%. Other people will get income and pay 53% if it's employment income. And there's a spectrum in the middle. And that variety and heterogeneity in rates at the top, again, regardless of what you think the overall rate should be, I think that is hard to justify. And that's definitely not neutral. So yes, I think some departure there between us on views on top rates. But let me stop there. Thank you.
Thank you, Helen. I should just say before I hand over to Jessie that for our audience members, we will have time for questions to the panel at the end. So there is a Q&A option if you want to submit your questions. I see a few people already have. And I'll hand over to Jessie.
Well, thank you very much indeed, James, and thank you, Tom, Daniel, and Helen for your excellent comments. And congratulations to CPS on producing this report. I think tax system is one of those fascinating things in tax where everyone has a tax they'd like to remove or cut, and very often they become great experts in that particular tax, but they don't always think about the wider overall picture, let alone the need to do a central function of tax, that is to say, to collect enough revenue to fund the services on the other side of the government's balance sheet. Now, I think the there's several points I suppose I would make about this. Of course, the report has the title of framework, and I understand exactly why that is, because it's had to be created and presented in the context of an economy with all the statistics pre-COVID. And so looking at it will have a slightly otherworldly feel to anyone who is having to deal with the current tax system as it is, and tax rates as they presently are and their effects. But at the same time, it's also a report which I think misses out, at least maybe I'm wrong, I haven't costed it quite with the full level that one might expect, given the importance of the topic of tax in general. But you know, the point that Helen raises about distributional consequences is absolutely foundational to thinking about how tax is going to work. And it's also foundational, not just in terms of equity and fairness, but in terms of what you might call the political economy of taxation. That is to say, maintaining the consent on which taxation always relies. Now, if I was going to make a couple of other comments about this, I would note that it doesn't, I mean, I'm not going to comment, as you might appreciate, I hope you don't mind, on current tax policy. That is a matter for the Chancellor, as we say in the Treasury, in the context of a fiscal event. And so anyone who's rabbinically pouring through my comments in the hope of finding some tell on what government tax policy is, I'm afraid is likely to be looking in vain. But I would just make a couple of points about the report and about the very interesting discussion that we've had. The first is that there are some quite punchy aspects to the report, and it's worth just dwelling on a few of them just for a second, and on the wider commitment it's made to tax to fiscal neutrality. So the first point is this. So one of the things it nudges up towards is the idea of a land tax. Now, that is perennially beloved of economists, and you don't have to spend much time engrossed in my book on Adam Smith, although I hope you will, to know that Smith himself was a very keen advocate of a land tax. But I would just remind everyone that it is a tax which has, even in principle, some pretty interesting potential implications, because it would require in principle at least, the valuation of every property in the country, and that would include personal private properties as well as business properties. And anyone who's looked at the struggle that successive governments have had in dealing with valuation of council tax will understand that that presents a non-trivial challenge to our public administration. That's one thing. The second thing is it contemplates broadening the VAT base. And that again is a perennial of discussion about taxes, but very much harder to achieve in reality than as it were, what the authors might fondly expect. I mean, if they are looking, for example, to extend VAT to the City of London, financial services, that would be an interesting potential extension of VAT for us to discuss. I obviously am not commenting on its merits. Obviously, there are some very well-known examples in which we're about to remove VAT from the so-called tampon tax after the 1st of January, and that is it's widely flagged and trailed. Everyone knows that. But imagine how people would feel if that decision was repealed and we went back to having a tampon tax. And that's just the small tip of a very large iceberg. And there's one area where I think the report is just flat out wrong, and that is on a digital sales tax, which is an attempt to gain some recognition in the tax system for UK user-generated content, and is itself, and has always been described by government as itself a preliminary to a wider international agreement. So to say it should be abolished in favour of an international agreement is simply to state what the longer-term government's tax policy already is. And if you want to abolish before that agreement, then I think it's a mistake. But I think the difficulty of those aspects reinforces a wider, deeper worry about the report, which is that that its claims to tax neutrality may not, in fact, be justified, and it may, in fact, be covertly, far from being tax neutral, in fact, rely on some very bold assumptions about revenue, which are unlikely to be justified. And I think that undercuts the theoretical basis for it, because we need as much reality on the revenue side as we need on the loss side if you're going to judge a package of reforms. And that's before you get to Helen's gently worded but lethal challenge which is that if you really believe in tax neutrality across and within different tax heads, then you should be, on her analysis, at least on the IFS analysis, looking to raise dividend taxation rather than reduce it. Again, I don't comment on the merits of the policy. I just point out the intellectual inconsistency. Now, let me just say a couple of other things. There was a crucial aspect to tax, which I didn't see in the report, but I may be wrong, and I think it's very important, and it's close to my heart, and that is what you might call tax administration. And we've done a lot of work thinking about how we can develop a 10-year strategy to improve tax administration, precisely in order to make paying tax easier, in order to make avoiding it harder, and in order to facilitate and support business, and making tax digital for VAT, which is a policy that's already been announced, and the area that we're looking to move in terms of extending that to income tax and in due course potentially to corporation tax. Those are areas which I think have the potential to make our system much more flexible and adaptable. But they also reinforce an important point about HMRC, which is that it is becoming not merely, although it will centrally always be, a tax authority, it's also becoming a resilience agency. And my final point would be that HMRC is also, in a funny way, becoming a productivity agency, because the move towards digitalization of the tax system is itself a move which nudges the longer tail of businesses in this country to become more digital in the way they operate. And if we can use that as a way of boosting productivity, that will be a tremendous long-term economic achievement. And that, I'm afraid, in turn raises a further worry about the CPS's excellent report, which is what does it mean to say that a system, an economy, is tax competitive? I can think of several different meanings it might have. It might mean that these distortions that have been described have been removed. It might mean it was low tax economy. People often talk about the highly competitive meaning essentially low tax. It might mean that the competitiveness of the firms that are nurtured within that country is such that the country as a whole is competitive, and the tax system abets that. And if you look at the UK, we don't seem to have much trouble attracting international capital to this country, and globally we've been one of the leaders in doing that for hundreds of years. So it's not clear to me that this preoccupation with tax competitiveness is in and of itself anything other than an important but small part of a wider economic picture on which I want us to be thinking about competitiveness much more generally, including productivity, technology, and also very important things like the health and well-being of our population, as human factors and human services become an even more important part of our international economic productivity and profile. And so I think that's the context in which I would see a tax conversation. If you think that's right, then you're going to worry about whether tax competitiveness as an idea is undermotivated or too narrowly drawn. And so I hope I haven't disappointed you, but I'd like to suggest that there's some intrinsic inconsistencies as well as some undermotivation for this otherwise interesting piece of work.
Thank you very much, Jesse, and indeed all of you. Plenty to discuss and debate there, I think. I think probably I would start off by maybe going to Daniel and sort of putting to him some of the points that Jesse was making there about the question of how exactly we define competitiveness within a tax system, and sort of how it is that the Tax Foundation go about putting together their index.
Yeah, so thank you, Jesse, for those great remarks and critiques. I think it points out to what we have in this report and what we have with the lens through which we're looking at the UK tax system, that certainly there are some blind spots. We are looking at this through a particular framework, which is the International Tax Competitiveness Index, but it certainly does not cover a couple of things that Helen mentioned, which is the tax neutrality across legal forms, or the tax administration piece that you mentioned. And again, it doesn't as directly create a question of this, the distributional nature of different tax reforms. So it is, you're absolutely right that it is not the only thing that we should be considering when putting forward a tax reform. And certainly there are political considerations that you would need a coalition not only to implement, but to follow through on things for the stability of the long-term tax system. I think one of the things that the index is very good at is identifying rate and base alignments relative to other countries. Now, whether those rate and base misalignments are things that are worth being picked up and run with from a political point of view and from a distributional and administration point of view, that's an entirely valid conversation. But I think the point of the report, both the International Tax Competitiveness Index and some of the reforms that we outline in our report, is to point out the misalignments. Now, it's not necessarily true that everything that we're going to do is going to drastically change, as Helen was pointing out, the rate of growth, but it can promote a more efficient tax system for a higher level, as she was pointing out, of growth for the longer term. Now, whether this also changes the rate of change on FDI and things like that, you're absolutely right that the UK is an attractive location for business investment, but I think it's worth looking at whether that's just the UK as an attractive location for foreign business investment, or if, as you pointed out, it can be a better location for nurturing local businesses and allowing them to have an opportunity to compete on a global scale, or to be able to compete even within their region. And the changes that we have on the capital investment front, both with business rates and on allowances, I think would speak to that. So I think those are very helpful comments, and I'll admit that there are pieces of the tax reform conversation that are outside the scope of this report, and I think you're absolutely right that they need to be part of the conversation. But using the lens that we have, I think these misalignments are pretty clear in the index.
Tom, did you want to respond at all as well to some of the things Jesse said?
Yeah, just to come back on a couple of things, actually. So I think, first of all, just to follow up on Daniel's point about what competitiveness means, or what do we mean by competitiveness in this report, it's very important to stress that this isn't about the overall tax burden. Look, Estonia comes top of the International Tax Competitiveness Rankings. It has done for 7 years, and it has more or less exactly the same overall tax burden as the UK. Sweden outperforms us, despite having a dramatically higher tax burden. So it's not about the tax burden. I think it's about two particular things. It's about the neutrality of the tax system, the sort of underlying quality of your tax structure. How much does it distort economic decision making? How much does it leave business decisions to businesses, or just economic decisions in general to individuals? And how high are marginal rates compared with other countries? And that will have a particular impact on investment decisions and incentives in the economy. So I think it's important to be sort of just clear about that. But I think it feeds into a second point, which has come through, certainly, Jess, in your remarks, and possibly Helen's as well to a certain extent, which is, if we're talking about competitiveness in those terms, and we're sort of using it as a synonym for how pro-growth the tax system is, broadly speaking, are we right to focus on economic growth that much? Should we be paying more attention to inequality, to the distributional effect of the tax reforms that we're proposing? Now, I would say we really do need to focus on growth more than we do. I'm not suggesting, of course, that it would ever be the only concern. Not for a think tank, and certainly not for government. I appreciate the context in which you operate. After all, governments have to win elections if they're going to be able to govern. But I don't think we pay enough attention to growth. I think growth is absolutely essential in the UK at the moment. It's a cliche, but more than ever. And I'm not just talking about an inevitable bounce back from COVID-19. I'm talking about getting our economy performing better and more strongly in the long run. I think government can affect growth. And I think that tax is one of the main levers they have at their disposal to do it. So that's the debate that we're particularly trying to contribute to. How can the government boost economic performance through tax reform? And I do, just on this point around distribution and inequality, of course it's important, but I think it does lead us down a dead end if we assess every policy proposal purely through that lens. And I think that there is a line of thinking in Westminster politics at the moment, which is that a reform can only be a good reform if it increases progressivity, if it diminishes inequality. And I'm not sure that that's right. Of course, we always want to make sure that anything we suggest isn't going to harm the least well off. But I don't think we should be tied to a particular distribution, or that progressivity should always be an overriding ambition when we propose reforms. Because I think if you focus on those two things, you really rule out an awful lot of growth-oriented policy. And you shut down, I think, one of the key avenues the government has to boost our economic performance. You also, if we talk about it in political terms, you concede the entire terms of debate to the left. And so I think conservatives are then left fighting a rearguard action to prevent a gradual dragging of the economy towards a more sort of state-heavy direction. The final point I just wanted to mention briefly, because Jesse brought it up, and I entirely understand people wondering, could this package of measures really be revenue neutral? Now, I do think we have worked quite hard to try and come up with a revenue neutral package here. The only place where we've assumed in any way significant behavioural effects is on stamp duty, and I think that that's quite well justified. Of course, any revenue neutrality, if you're cutting some taxes, is going to depend on increasing revenues elsewhere. And there are, of course, enormous political challenges, which we're in no way blind to, around things like the VAT base, around a better approach to property taxation, and so on. But I just wanted to make that point that it is possible to do pro-growth policy without putting a dent in government revenues. But of course, there are trade-offs and hard choices. And that, I think, is at the heart of the discussion that we're having.
I'm sort of interested as well, since one of the things that both Helen and Jesse sort of raised was the dividend issue in particular, but sort of, I think in general, the question of that HMRC have been wrestling with, particularly over the last sort of 10, 15 years, which is the question of the way that people remunerate themselves and whether, different ways of doing that are sort of advantaged over others, and whether some of those sort of, whether those things are distortionary or whether they act as incentives to do things that are economically beneficial. That's not just about national insurance for self-employed and that sort of thing, but there's also issues like entrepreneurs relief, for example, which a lot of people talk about at the moment, about whether that is sort of value for money in terms of the lost revenue compared to the potential impact it has. What's the sort of, what are panelists' thoughts about that area of policy, and whether is that going to be sort of one of the big focuses of the Treasury over the next couple of years?
I don't know if Helen.
Are you aiming that at me, James?
Well, either Helen or Jesse. I was sort of, since
Helen,
you both raised the issue.
Okay. Well, so I have very strong views on this, so I'll try and be brief and not monopolise the rest of our time. Are the Treasury going to look at it? I mean, I think one of the reasons pointing towards yes is that they're losing a hell of a lot of money, and as more people set up in self-employment, even if that's paused now for COVID, we're still looking at billions of pounds of revenue that isn't coming in because people are structuring themselves that way. So I think it is an area that should be looked at. I mean, to the way you framed it, James, I think I'd frame it slightly differently. I mean, lower rates of tax, however they arise, whether it's entrepreneurs relief, dividends, NICs for self-employed, of course you're going to find people who are incentivized by those rates. In some ways, that's the easy bit. That's kind of not the question. The question is that a good way to do it? Are the benefits of doing that outweighing the costs? And my argument would be no. So we try to incentivize entrepreneurs or business activities through lower self-employed rates, dividends, capital gains. And the cost we bear for doing that is, one, just the unfairness that people with the same incomes pay to very different rates of tax, and the inefficiency of people now structure their activities not purely for commercial reasons, but for tax reasons. And we're seeing people setting up businesses, and we see this, we've used HMRC tax records, we look at this directly. We see people setting up businesses for tax reasons, hoarding money in their companies to get entrepreneurs relief. Entrepreneurs relief is not going to entrepreneurs predominantly. It's going to people who are able to set up companies and save money in their companies, and they're different people. So even though some entrepreneurs get it, some entrepreneurs don't get it because they weren't able to get capital gains. They weren't able to, they failed, so they didn't get it, for example. So yes, there are incentives. I think the better way to deal with that problem, the incentive problem, is to think about the tax base. I know one of the questions, I can't remember who asked it now, but in the Q&A was about, what does that mean in practice? Again, that's a kind of a long technical debate, but to give you one flavour of that, it would mean if you put money into a company, you get some upfront relief. So a bit like a capital allowance, you say you put money into a company, a bit like a pension or an ISA, you can do that tax-free, and then you only get taxed if you make a profit in the future. So basically, you incentivise investment when it happens, at the point where they're doing the good stuff that's good for growth. What you don't do is say, well, now you've made a profit and you've maybe got some monopoly power, you've made, you've made it. Now we'll give you a big tax relief. That kind of comes at the wrong end of the investment, as far as I'm concerned. So again, to your point, James, yes, these things have incentive effects, but I don't think they do it very well. And they're poorly targeted. We could do it better in a way that was more efficient and less costly in terms of unfairness.
Jesse?
I mean, just to follow up on that, I'm not going to go discuss entrepreneur's relief because Helen has put one side of the argument extremely effectively. I would just say that, I mean, I'm not quite clear on what the CPS's corporate position on this. Is it to have neutrality on these things, or is it to incentivize tax, to use tax as a mean? I mean, I thought the whole point about entrepreneurship was you're supposed to be operating on the basis of the economic incentives, not the tax incentives, right? So I don't really understand how this fits intellectually into the picture that the CPS is advocating. But more precisely, I mean, just to build a further point, I don't know about you, but I know very few entrepreneurs who actually go into business. And certainly I never have, and no member of my family, all entrepreneurs and many others, ever did it thinking about the tax return. What we think about is, how can you build a better widget? And how can you sell it to millions of people around the world and build, beautiful happiness? And, my father invented Polly Pocket. I mean, he didn't do that because he wanted to make a tax gain. He did it because he thought that was how to, you needed a, what is it? What was his line? His line was a mental age of 7 and an eye for detail. That was how you created a toy that was going to give enormous joy to millions of kids around the world. So I don't even think that appropriately characterizes how entrepreneurs actually think. And therefore, I certainly doubt the incentive characteristics of it personally, but that's just, it's not Treasury policy, just my personal, a personal question. Now, let's just pick up some of the points that Tom made, though. I hope you don't mind, I'm going to return to those for a second. Listen, it's very easy and slightly prejudicial to talk about politicians as seeking to win elections. And of course, some politicians are seeking to win elections at some points in the political cycle. But that's not what was going on here. What's going on, the reason to think about these issues and to think about issues of inequality are, first of all, because inequality in and of itself is not a good thing. And secondly, because it's really important, as I said earlier, to maintain the consent on which we tax people. And you don't do that if you have a tax system which has egregious inequalities built into it. And that's a concern. Now, there might be other reasons that are countervailing considerations in the formation of policy, but it's important to be aware of that. And it's important to move away from the idea that this is just about, as it were, a Buchananite type analysis of politicians as an interest group in their own right, desperately seeking to feather their own nests, because I frankly think that's nonsense. Let's just pick up another couple of things. Of course, growth is important. The Treasury spends its life thinking about how to improve growth. I mean, that is absolutely a central part. But we're also, I think, rather proud of the fact that we have done all this work on distribution analysis. We do have better tools now for understanding. We're able to look to people like the IFS and others for much more sophisticated conversation about the interaction between tax and benefits, how households are affected by economic policy. And I think that's all to the good. And of course, I also, if I may say so, disagree with you that the idea of inequality is something that should be preserved of the left. I think there are many conservatives on all political parties who have a proper concern about inequality and trying to minimize it and trying to make sure that that takes its place within an effective and highly productive. And it's quite interesting that countries which have lower Gini coefficients than ours, such as Sweden, score very highly on the tax competitiveness index that Daniel was describing. And that suggests that those two things are somewhat orthogonal to each other, if I can use a technical term. I don't know if that makes any sense, but those are my reactions to the points you were making, Tom.
I think one thing on that point that you just made there, Jesse, is that if you look at the tax system in and of itself, that you may see just a distributional burden of the tax system. But if you're able to look at the tax and benefit systems together, you may see another distributional impact. And I think that's one of the things.
Of course. And by the way, that's a conversation we have the whole time in Britain, as
Right.
Helen will know.
Right. And I think that's important to think of what an efficient tax system might be able to do as far as raising revenue and promoting growth, as far as supporting the other government services that on the other side of the balance sheet offset some of the distributional impacts. And I think that, you know, entire total conversation is also kind of important here, because when you talk about Sweden, it's both sides of the coin there that come out in those distributional impacts. I think it's also important to think if I could go back a little bit to the entrepreneurs relief conversation, there are plenty of tax systems in the world that are basically providing a tax windfall after the innovation happens. And I think of this in the context of research and development credits, when the research is happening and when the money is being invested for the research, and then the patent box on the other side, that in some ways, once the product's been developed and it's like you were talking about with Polly Pocket, once everything's done and you're making people happy, and then there's a tax break. And so making sure that the tax policies are targeted towards the general, the general business investment incentives, rather than just a windfall after the fact. And I think that's an important thing to keep in mind with these various policies.
Tom, do you want to just come in briefly, because I want to move on?
Yeah, I mean, very briefly, and this is somewhat of a redirect, but I think that one of the issues underlying the discussion we've had about whether we're overtaxing or undertaxing investment and so on, it has to do with national insurance and basically the weirdness of the national insurance system. And I think, to criticize my own report, we don't pay an awful lot of attention to the role national insurance plays in our tax system. I think partly because we're basing this on an international comparative analysis, and we're sort of treating national insurance contributions as being analogous to the social security contribution systems that many other countries have. And of course, that's not really true in the UK. It may have been once upon a time, it's not anymore. And it's a broader and different question, but I think we do need to sort of think about and make a decision on, is national insurance really just income tax? And if it is, why are we running two completely separate systems in parallel with two separate sets of rules? And I think if we could intellectually come to an agreement on that, then many of these other questions would be easier to analyze and easier to resolve. But I could go on. I won't go on. Let's move on to another question.
So there's a lot of people in the Q&A sort of raising the question of politics and the difficulty of these things. A lot of the things that we've been talking about and that Helen mentioned as well, you know, when we look at council tax, for example, and look at the issue that you were just talking about the national insurance system. You know, I know you said in your contribution, in your introductory remarks, Jesse, that, you know, we've looked at lots of these things before. It's the same about the VAT exemptions, and they're very politically controversial and they're very sort of difficult to do. What is the sort of, obviously the result of that is that with council tax, for example, it's been kicked down the road and it's not been revalued for 30 years, which everybody agrees is terrible, but nobody can really sort of work out what the best way to tackle that politically is. What is the sort of approach that we need to be taking to get these things through that basically everybody tends to agree are broadly sensible and need to be done, but take quite a lot of political will? That was mainly sort of directed at you, Jesse, I think.
Are you asking me?
Yes.
Yes. Well, no, thank you for that. If you recall, I was studious about not really talking about the Treasury's experience of these things, but rather just interrogating them on their own terms, and just, you know, wanting to ask the question whether the report was, for example, extending VAT to financial services or to women's sanitary products after we leave the EU finally, as it were, next year. I mean, you know, until you spell out where those are, there's going to be a question about the revenue assumptions that are made, and maybe the report does spell that, and I've just not got to that bit yet. So on the wider question, listen, how change occurs in the tax system is one of the deepest questions of politics, and it's a function of a moment, and it's a function of a set of beliefs and views, and sometimes it can have a cross-party aspect to it. And it's a particular shame that the British system over the years has been relatively less good at fostering the kind of consensus that would be required to make change and then holding to it. And I won't talk about the tax system particularly, but obviously the area on the spending side, where we see this most of all, is social care. Everyone thinks we need to address some very serious issues in the provision of social care, and yet we have not been able to forge a political consensus over decades that would allow us to do that. And that remains one of the biggest challenges, and I've no doubt that it has its parallels elsewhere on the revenue side of the equation.
Helen, what are your sort of thoughts on why is it that a lot of these things are sort of seem to never get done, and what's the answer? And how do we sort of how do politicians pluck up the courage to do some of these things?
Yeah. Well, I mean, they're big and hard, and you make lots of losers, and making lots of losers is difficult politically because losers tend to shout much louder than winners. Losers tend to be small and concentrated groups, and winners tend to be dispersed groups, and one shouts louder than the other. I think that's kind of the core of the problem. But I think there's also an issue that no one should be expecting, well, two things. You shouldn't have to make tax policy overnight. So I do happen to believe that we should get rid of all VAT zero rates. I think they're a horrible part of our tax system, and they really don't help poor people very well at all. But obviously doing that overnight in a pasty tax style way would be silly. I think we'd have to really do the groundwork, almost pick an area of tax, and then do the groundwork to explain to people, like adults, how the tax system currently works, not in the minute detail that no one cares about, but what is the tax system doing, and sort of make the case for reform and why it would be better, and put forward a fully fledged, say with VAT, just to take the example, we would get rid of the zero rates, and here's how we would do the benefit system to compensate poor people, and here's who would be winning, and sort of go through the motions with people. I think that's one type of answer. The other thing I think is we should be more confident when we make policy of these long run problems. So with council tax, I have to say I'm increasingly coming to the opinion, quite depressingly, that will only fix it by scrapping it and getting a new version of council tax. Basically, that's what we did with the last system. We had a property tax. It got so bad that we had to scrap it and get council tax. We'll do the same here, I suspect. So what we should do next time is design a tax that we know, we build in the valuation process up front. We know this is coming down the line, and we tell people up front how it's going to happen, rather than letting it sort of like we do a big bang new tax and then sort of let it drift into the future. So I think better explanations of why we're doing things and making a case and explaining things. And making tax policy sort of with the future in mind, knowing that values are going to get out of date and things are going to change, and let's sort of make it as future-proof now as we can. But none of that changes the fact that this stuff is hard, and we're not going to change all the tax system overnight. We have to, I think, pick one area and focus on, or a couple of areas, and focus on making change there. Which is one more thing. Sorry, the third one more thing. Which is why I pointed out the point about progressivity and the trade-offs, and how some structural reforms are just good reforms regardless of your political preference. I think we pick some of those that hopefully the Conservatives and Labour could all get behind. Maybe then we've got a better chance of actually taking some of those through from big idea to fruition, because they won't depend on any particular political party being in office. So in some ways, I'm most optimistic if we could really find some common ground in some of those types of structural reforms.
And we've just got a couple of minutes left. I think just at the end, I want to sort of bring it back to our core theme of growth, and maybe go to Tom and Daniel on some of the things that have been raised in the Q&A. Firstly, about the post-COVID recovery and what role tax can have in that. That's a particular issue. For obviously, this paper is a paper about comprehensive tax reform. So what are the sort of things that we can do quickly and maybe on their own to help the recovery? We've also got a question from Paul Goldsmith about the sort of relative merits of having geographically focused tax changes to incentivize investment and so on in particular areas, and what that can do for levelling up in the UK. So some brief comments from Tom or Daniel.
Yeah, sure. I mean, let me go first, James, and just say this is part of a broader CPS policy agenda or work stream, if you like, which is all about going for growth after COVID. And tax, you know, I'm the head of tax at the CPS. I would say this, I think tax is very important. That's been the subject of our discussion tonight. It's one of the main levers government can pull. It's not the only one, of course. We can also look at regulatory reform. I think reform of the planning system is absolutely essential in terms of boosting long-term growth in the UK. Things that we could prioritise in the short term after COVID-19. Wonderful to think that there will be an after COVID-19. I trust that will be the state of affairs at some point. You know, look, the government has already made a great step on stamp duty land tax. Let's not take a retrograde step and go back to the way things were before. Let's continue to make progress and hopefully work towards abolishing that tax altogether. I think we do need immediate attention on the issue of corporation tax capital allowances, because as things stand, I think that the annual investment allowance is going to fall from 1 million to 200,000 at the end of the year. Sort of the last thing you want if you're trying to get the economy back on track and get businesses investing again is that sort of change in the tax environment. I think I had one other thing in mind, but we're more or less out of time. So let me pass it over to Daniel and see if he has any additional thoughts there.
Yeah, and me for the out of time comment. So I'll just echo what Tom said there. And I think one of the things that we're trying to do with this report is take what we know about tax and incentives and tax and neutrality, and within a framework that we've talked about that doesn't necessarily cover everything, but within this lens, think about what can be improved. And I think Tom is exactly right on stamp duty land tax and on investment allowances. I think, you know, one of the things that we've seen recently, both with US tax reform and Canada not too far after, and Australia recently, is really making sure that the capital allowances are generous for business investment. And I think that's going to be a key thing for the UK. You know, once COVID is over, there's going to be a huge surge in growth that is just a reopening. But what you want to see is a long-term level above where we would have been otherwise after COVID. So I think it's important to think of, you know, what in the tax system could be changed for that long-term growth prospects.
Thank you very much. I think that was a fantastic discussion. So it only remains for me to thank our panelists, Helen Miller, Tom Clougherty, Jesse Norman and Daniel Bunn. I have been and still am James Heywood of the Centre for Policy Studies. Thank you all for joining us. Hope you enjoyed the discussion and enjoy the rest of your evening. Thank you.
Thank you, everyone.
Thank you.
Thank you.
Thank you.